Based on the marketable borrowing estimates published on July 31st, Treasury, this is crazy, Treasury currently expects privately held net borrowing of $1.007 trillion in this quarter, with an assumed end of September cash balance of $650. And then they said we expect another $852 billion of borrowing next quarter. That means Treasury is going to try and issue and sell $2 trillion worth of Treasury bonds in the next 2 quarters. That's $2 trillion of new borrowing by the federal government to pay our bills. At the start of the year, they were estimating $1.6 trillion for the year, which was an insane number. Now we're talking about $2 trillion in just 2 quarters.
A few days ago, the United States Department of the Treasury announced its current estimates of privately held marketable borrowing for the July to September 2023 and October to December 2023 quarters. During the third quarter of the year, the Treasury Borrowing Advisory Committee estimates that the department will borrow $1.007 trillion in privately held net marketable debt, assuming an end of September cash balance of $650 billion. The updated borrowing estimate is $274 billion higher than what was announced less than 3 months ago. During the fourth quarter, Treasury expects to borrow $852 billion in privately held net marketable debt, assuming an end of December cash balance of $750 billion. During the latest episode of the All In podcast, venture capitalist Chamath Palihapitiya, entrepreneur and angel investor David Friedberg, and David Sachs, co-founder and general partner at Craft Ventures, discussed the federal government's massive debts, increasing debt expenses, and how the nation's continuous unchecked fiscal spending can negatively impact its growth in the nearest future. According to Friedberg, who highlights several signs of impending doom for the U.S. economy, we risk the dollar losing its global reserve currency status if immediate actions are not taken to reduce the federal government's massive expenses. Friedberg cites the example of major credit rating agency Fitch, which on Tuesday downgraded the U.S. government's credit rating from AAA to AA+. He explains that investors are fast losing confidence in the U.S. government and its ability to continue to finance its very massive debt obligations. Chamath disagrees with Friedberg's conclusion, explaining that as dire as the situation looks for the U.S. economy, it's much more dire for all other economies. Sachs chooses a middle ground. According to the former PayPal product leader and founding COO, the U.S. might not be facing an impending collapse, but there are lots of clear signs of trouble. We will now bring you some important highlights from the spirited discussion. Please watch the video to the end, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and thoughts on the trajectory of the United States economy in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
This is a pretty striking chart, and I think I showed this before. This is federal government interest payments that are being made. We're now up to, $1 trillion. The chart, as you can see, a year has spiked. And by the way, that number is spiking further, and we'll talk about this in 1 second, as a result of rising interest rates and increased fiscal spending. So this is now becoming a pretty sizable part of our budget. And as of now, paying the interest on our debt is a larger capital outlay for the federal government than defense spending. The second chart shows what happened in the last week, which is that 30-year treasuries have been sold off. And as that's happened, treasury yields have climbed. So there's been about a 10% decline in pricing and a concurrent nearly 10% increase. And Bill Ackman, basically said today that he's shorting 30-year treasuries. He thinks we're going to go to 5.5% long-term rates. Currently, the 30-year treasury is sitting at 4.3. And remember, I told you guys this after this thing I went to a few weeks ago, that there were 2 prominent economists who shared that they think we're going to be facing long-term rates in the 5 to 7% range, very long-term rates for a very long period of time, that it is a new fiscal regime. And then if you pull up the last link I sent, Nick, this is a report made by the Treasury Borrowing Advisory Committee of the Treasury Department. And I just want to read a couple of quotes from this report. This just came out today, and it was published. It was sent over to the Secretary of the Treasury yesterday. And it said, since the advisory committee convened in May, 2-year treasury yields are about 100 basis points higher, while 10-year treasuries have increased by about 40 basis points. The bank holdings of non-mortgage-backed government securities, mainly treasuries, have actually declined by $146 billion so far this year. So that means banks are selling off their treasuries. The committee goes on to say, at the same time, treasury investors have noted the treasury supply will need to increase to address the rise in public deficits, as tax revenues have come in weaker and government spending has increased. Rates are climbing. As a result, we need to borrow more. And this is a perfect manifestation of the debt spiral problem that we've talked about multiple times. Our fiscal spending outlay and the rising interest rates combine to create an insurmountable debt spiral that is now manifesting in the fact that we need to sell $2 trillion of treasuries. And here's the crazy statistic that they said. In reviewing recent demand for US treasuries in auctions, the committee noted that an increasing percentage of supply is being absorbed by investment funds, while foreign participation has remained range-bound. That means as we're trying to sell more treasuries, foreign governments are buying fewer of them, which means that the US currency as a reserve is no longer the place that everyone wants to plow their money as much as it used to be. It is in decline. Now, the other thing I want to share, which I think is absolutely critical, is how do we address this gap? Well, the one way is these entitlement programs. And so several Republican presidential candidates, Nikki Haley, Ron DeSantis, and Mike Pence, have all publicly stated on the campaign trail that they're promoting programs to cut Social Security benefits for people that are 30 and 40 years old. And here's the response to that. A poll was done. And on that poll, 82% of voters oppose the push to cut Social Security for Americans under 50. 82%. So where is this going to take us? This is what is so scary to me, JCal. I'm not an American declinist. I believe in the American system. It benefited me and my family. But I do worry that we find ourselves in a whirlpool that is very hard to get out of because the populace says we don't want to make the cuts that are necessary in order for us to save ourselves. That's what's so scary to me.
Friedberg reckons the US dollar might not lose its status as a world reserve currency anytime soon, but its purchasing power will continue to get eroded until the dollar is worth nothing at all. According to Sachs, the first sign of trouble will come from the stock market. With the federal government so desperate to sell its multi-trillion-dollar bonds in less than 200 days, Sachs explains that Treasury will be forced to jack up bond yields to make them more attractive to investors in and out of the United States. This will, of course, significantly reduce the amount of money going into the stock market, slowing down growth and overall economic activities. For Chamath, the future looks more optimistic for the United States economy, especially when compared to how other major economies like Japan are faring right now. Here are more clips from the interview.
Let me just state what I think about the downgrade. It's irrelevant. The S&P did it 13 years ago. Fitch is a marginal credit rating agency. They're at a minimum 13 years late. At a maximum, they're just anxiety-ridden, like other people are, who are always screaming that the sky is falling. So that's my first point. The second point, and the more important one, is that none of you who are always freaking out about this understand this conversation about relativism. All of these conversations are relative. You deal with them in absolutes. On a relative basis, Japan's debt to GDP is 270% and growing. On a relative basis, our debt to GDP is half of that. We are the most important economic force in the world. It is going to continue to be the most economic force in the world. And all I see actually on every single monetary basis is every other country struggling more than we are. So my question to all of the Chicken Littles is, what do you do if you're a central government where you have to have foreign reserves? Do you all of a sudden double down on the euro? Do you double down in the yuan, which is basically a proxy for doubling down in the US dollar? What are you supposed to do? And I never get a good answer because on a relative basis, the US will still continue to do well. I think that debt to GDP is a red herring for a lot of people. And I think that the way that people run their personal lives, which should take income to debt into consideration, I don't think applies as much to governments. And I think these things are going to march forward as a group. There's not going to be a single G8 country that all of a sudden moves away and starts printing surpluses. It happened almost as an accident, an aberration during the Clinton administration. It'll never happen again. And I think that we shouldn't worry so much because I just don't see an alternative. So give me, instead of telling me how bad this is because you think about your own life and how it would be bad if you had debt to GDP of 100, I get it. As a country, give me the alternative country. But just start with that. Can you answer that question? What is the alternative country?
Well, let me paint a scenario that's not as dire as a collapse of the US dollar as the world's reserve currency. Let me paint like a non-catastrophic scenario or non-apocalyptic scenario, which is what you saw in this Fitch ratings downgrade is that the bond market did move at the margins. There was a sell-off in the 10-year. And as a result, the 10-year bond yield moved up to 4.2%. So it wasn't a case of everybody shedding all of their US treasuries. It's just that there were market actors at the margins who adjusted their portfolios. Okay, now, Freeberg is saying that the Treasury is going to have to do another $2 trillion bond offering. And we have $1 trillion plus deficits as far as the eye can see. And we've got entitlement liabilities on the horizon and then a political unwillingness to do anything about it. So the deficits are only going to get bigger and bigger. Now, what does that do? It's supply and demand. When the US Treasury needs to keep issuing more and more bonds, at some point, the demand for those things gets incrementally saturated and they have to offer a higher yield. So what happens? Well, the bond rates go up. And so the 10-year goes up, like Freeberg was saying, from 4.2 to somewhere in the 5 to 7% range. And that doesn't mean the US dollar is not the world's reserve currency. It just means that it gets incrementally harder and more expensive to keep financing our debt. Now, what is the result of that? Well, if I, as an investor, could theoretically get 7% from the US Treasury as the risk-free rate, why would I want to take equity risk and put it in the stock market, which historically has yielded somewhere in the 5 to 7% range? So if I can get my 5 to 7% from a risk-free US government bond, of course I'm going to do that. So the discount rate on equities will go up. That means that the stock market on a relative basis will go down.
Risk capital will go down. There will be less risk capital.
Will go down, and there'll be way less risk capital available for things like venture capital and private equity, just risk-taking of all kinds. And so the economy will just grow slower. It's not like there'll be a collapse. It'll just be this huge albatross around the neck of the private sector. And this is called crowding out.
This month, Treasury will sell $270 billion in notes and bonds, $24 billion higher than it sold in July. It will increase the auction size of notes and bonds to $103 billion this week, then sell another $167 billion in notes and bonds later in the month. The increase will be higher at $35 billion in October, when the department will increase its issuance of notes and bonds to $281 billion. By August 2024, the Treasury Borrowing Advisory Committee estimates that Treasury should have jacked its monthly issuance of 7 May notes and bonds by almost 60% to $354 billion. The committee also notes that these quarterly estimates can be jacked up over the next quarters to account for the federal government's reduced revenue and increased spending. What are your thoughts on the tsunami of notes and bonds that are about to hit the markets? How do you think it's going to impact cryptocurrency prices over the coming months? Please drop your replies as well as your comments on the video and the featured discussion in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.